Well, I must tell you, it is a great pleasure to be with you. On a sadder note, you noticed that Julian Good and I were going to do this together. Last Sunday afternoon, I got a text from Julian, his wife's sister's husband. She found him, he died of a heart attack. So Julian is sorry he can't be here with you. Obviously, I think you understand. And he said to give you his regards. I'd like to follow up with what David said. Excellent presentation, by the way. And hopefully the presentation I'm going to give you will show you a tool to discover the type of prospects that David has talked about. And it's called the Individual Federal Income Tax Return. It's all between the lines. So, with no further ado, let's get started and see what we can find out here. Now, question, how many of you, when you call on a new prospect, pick up tax returns? Good. I think after this presentation, maybe you will never not walk away from a prospect's home or office without picking up the tax returns. Because if you pick them up but don't know what to look for, it won't do you much good. So today I'm going to try to give you a brief overview of the sales opportunities that you can find in federal form, tax form 1040. So here we go. The first place to start is form W-2. And of course, everybody has seen a W-2 in their lifetime. You probably get them or have from your place of employment. If you'll notice on the W-2, the first thing to notice is there a difference between line 1, which is wages, tips, and other compensation, and line 3, Social Security wages. A difference here indicates that a person is either a participant in a 401k plan, a 403b plan, and or a Section 125 plan. Box 11 indicates a distribution from a non-qualified deferred compensation or non-government Section 457 plan, which this is included in income in Box 1 or Box 3 and or Box 5. Box 12C indicates the taxable portion of group term life insurance in excess of $50,000. As we all know, the premium on the first $50,000 of group term is tax-free, and anything over that is taxable at the government rates. Questions come to mind when you see this. Is there a need for individual life insurance coverage? Could you position yourself to review their employee's existing benefit plans, or could you position a colleague or an outside firm who you could split the business with? Box 12D includes the following information. Line 12, code D, indicates the individual is contributing to a 401k account. If you're doing planning for that individual, you want to make sure they're deferring the maximum amount allowed, or at least the maximum amount to get the full match from their employer. If code E is completed, the individual is voluntarily contributing to a 403b account. Code G indicates elected deferrals being made to a 457 deferred compensation plan. Code S means a salary reduction contribution under a Section 408P simple plan. Code Y indicates elective deferrals under a Section 409A non-qualified deferred comp plan. And by the way, all this information is on the back of the W-2. Code AA indicates Roth contributions being made to a 401k plan, and code BB indicates Roth contributions are being made under a Section 403B plan. Now here's one I like. Code DD is the cost of employer-sponsored health coverage. That's a new item as of last year's W-2s, and that of course is required under the Affordable Care Act. Note that at the current moment, this amount is not included in income. I said at the current moment. Who knows what will happen as we go forward. Notice line 13 will be checked if a retirement plan is in place. Now, After reviewing these items in box 12D in line 13, here's some of the questions that come to mind. If the client or prospect participates in a qualified plan, is there a possibility I could talk to their employer? What type of plan is it? Are they satisfied with the administration of the plan? Most plans don't move because of investment performance. They move because of administrative problems and the fees being charged. So you ask, are you satisfied with your administration fees? Are they reasonable? When was the last time you benchmarked your plan? Do you know there are services that you can benchmark your plan in the event that the Department of Labor comes in to audit you to see if your plan is reasonable? The only thing they don't tell you what reasonable means. But if you have a benchmark of your plan against other plans of your size done on a normal basis, I would say that you would have something you could put in your files to at least demonstrate that your plan is reasonable. Are the owners happy with the amount that they contribute to the plan? Most times they aren't. Most plans you try to design to get the owners the most money they can. And of course, can you review the plan's SPD and adoption agreement? And of course, there's no difference between 1 and 3 on the W-2. Perhaps that employer is a prospect for a pension plan. At that point, you want to know how many employees the company has, so you know if they're a prospect for a simple IRA or if they're a regular 401k prospect. Or are they a prospect for a non-qualified plan or a CERP? Now, that's just a W-2. As we stated in the beginning, when you're engaged in any type of financial planning, you should obtain at least 2 or 3 years tax returns. I will contend to you, if your prospect or client won't give you a copy of their tax returns, they may be saying, I don't trust you, and in all probability, they will not give you all of the data you need to do a thorough analysis. Now, David touched on the tax rate schedules. So here's the 2014 tax rate schedules. Notice under Schedule Y1, married filing jointly, that the 28% marginal tax bracket starts at $148,850. So what's so important about this? It's the difference between marginal and real tax brackets. Taxpayers do not pay income, as David mentioned, based on marginal tax rates. How many times have you ever heard anybody say, I'm in now the 39.6% tax bracket, or I'm in the 25% tax bracket? That's not the case. We all pay taxes based upon average tax rates. And here's an example. We have a taxpayer who is married and filed jointly with a $200,000 of taxable income. They are scheduled in a 28% marginal tax bracket. However, as shown below in this example, their actual tax bracket is 21.6%. That's the real tax bracket. And you calculate this as follows, as you can see. The $200,000 of income less $148,000 leaves you $51,000. That's taxed in the 28% marginal tax bracket. That's the only amount of the $200,000 that's taxed at the 28% bracket. The remaining amount of money is taxed cumulative in the 10, 15, and 25% brackets, which leaves you with a 21.6 average tax rate. Why is this important? You're selling an annuity, and the other broker is telling you it's not good. You shouldn't sell an annuity because when they take the money out, it is ordinary income, subject to the higher marginal tax bracket, whereby if they put it in a mutual fund or other stocks and bonds, when they sold it, it might be at a capital gains rate. This is an argument against that, that you have to look at the average tax bracket. So now let's move on to Form 1040. All right, right below the filing status section is the section that contains information on exemptions and dependents. Line 6C is where dependent children of any age are listed. Several questions come to mind here. Are you planning on funding your children's future education? What happens to your children and spouse if you should die or become disabled prematurely? Are there dependents on line 6C who do not live with you due to divorce or separation? If so, where do these dependents live and who's responsible for their care? What we find if a child is not living with a taxpayer due to divorce or separation, one of the first things that comes to mind is the possibility of a life insurance sale. Many divorce settlements require that life insurance be provided to a former spouse in the event of a divorce. So what you want to do is ask your client or prospect if they were subject to this requirement. Also ask how much they were required to purchase, what type of coverage was it, and when was the last time it was reviewed. Perhaps you should do a life insurance audit to this individual. Also look for other dependents on line C. Is there an elderly parent being claimed as a dependent? If so, then this taxpayer is acutely aware of the care required for an elderly parent or other family member and could be an excellent prospect for long-term care insurance. Perhaps this dependent is a special needs child. If so, the parents may need to engage in special needs planning and life insurance planning to take care of the long-term needs of the child. I gave a seminar once, and later a man and his wife called me and wanted to come by and see if they could make an appointment with me. They had a special need child, and make a long story short, he had some real estate holdings, put him with an attorney. We drew up some LLCs, ended up purchasing some life insurance because the need was there was another child, and in the event of their death, then the remaining child was to care for their special needs child. So be aware, acutely aware of that. It's excellent planning opportunities, excellent ways to purchase insurance. And I must say, on a sad note, this young lady passed away 2 weeks ago at age 52. So, but I think the mother and the dad had the satisfaction of knowing that had they lived long enough, she'd have been taken care of. It's also an excellent opportunity to inquire if all the beneficiary designations have been reviewed and updated. Now, line 7 on 1040 is only important because that's where you put everybody's cumulative W-2s. Let's turn our attention to line 8B, which refers to tax-exempt interest, and I believe that's some of the provisional income, right, David? Tax-exempt interest can only be generated from municipal bonds. As has been mentioned, if the taxpayer is receiving Social Security benefits, then tax-exempt interest is included with certain other income to determine the portion of a person's Social Security benefits that may be taxable. So, good questions to ask here. Is your tax-exempt income causing your Social Security benefits to be taxable? And I will tell you, after doing tax returns for soon to be 40 years, I can tell you a lot of people are not aware that up to 85% of their Social Security can be included in their taxable income. It's a shock to them, literally. They do not understand that. So, as you've heard before, if this taxpayer does not need the tax-exempt interest for living expense purposes, why don't you consider repositioning it into a tax-deferred annuity or a tax-efficient ETF portfolio? Because repositioning these assets could have a significant impact on the taxable income by reducing the amount of the income that has to be added to this that would require you to include your Social Security. I will continue to you, this is the most important schedule that you will want to look at. Line 8A, taxable interest income on page 1 of 1040 is detailed on Schedule B, Part 1. The questions here, and what this is It's where all of the interest income and the banks they get it from or savings institutions or wherever. We ask this question: are you receiving a lot of interest income from the banks? Well, obviously you can tell from looking at this. If so, are you spending it or are you accumulating it? What's the purpose of these assets? Is it intended for long-term growth? If it is, then why have you got it invested in for income? Could this amount of interest cause your Social Security income to be taxed? Let me give you a great example I had happen to me. Years ago, I still have, I had a client of mine was owner of a small auto parts store. Small, self-employed business person. Every one of them's got them in your communities. You think this guy wasn't making any money, had an old truck outside, but it was all part of the persona in his small town. He couldn't really let people know how much money he was making. So I'd done some business with him over the years, put in a KEO plan, did some life insurance on him and his wife, did some life insurance on the grandchildren. And then about 10 years ago, his tax accountant retired. So being the frugal man that he is, he called me up and he said, since I do so much business with you, will you do my tax return for free? When you hear the rest of the story, you will gladly know that I said yes. The first year he brought me his tax return, he had about $45,000 of interest income on Schedule B. As I said, very close-lipped man, never had discussed that with me, kind of doled out to me little bits and pieces every now and then. I'm happy to say that he still has $20,000 of interest income on the tax return I did this year, so I know he's got at least $2 million in the bank, but I have about $4 million of it. So I'm gradually banging away at it. But that's a typical example, literally, of someone I did business with for years and would have never discovered the amount of money he had I not got that tax return. I mean, so that's a sales idea right there. This is not all technical stuff. This is stuff that you can take and go use. So once again, if they're accumulating the interest, they're an excellent prospect for tax deferred or tax efficient products. If they're spending the interest, there may be an excellent prospect for some type of single premium or immediate annuity. Okay, line 9A, I'm sorry. Get back up. Yeah, here we go. Line 9A on Form 1040 pertains to ordinary dividends, which are detailed on Schedule B, Part 2. Here are the questions you ask here. And I can tell you this is a great place to uncover a lot of stuff. If there are a lot of dividends from stocks and mutual funds, then you've got a prospect for an annuity, variable annuity, or a tax-efficient mutual fund also. Questions to ask: have you ever rebalanced your portfolio? Do you even know what this means? If so, do you rebalance it regularly? Are your investment assets properly allocated according to your risk tolerance and time horizon? And these are very good discussions to open when you're trying to obtain a client for professional money management. And I'm going to come back and I'm going to tie some stuff in when I talk to you about Schedule D, where it shows the capital gains transactions and the things you look for there. But for right now, let's look at line 11 on Form 1040. That indicates that an individual is receiving alimony as a result of a divorce. Later down in the front page of 1040, line 31A indicates that an individual is paying alimony as a result of divorce. Once again, you ask these questions. Did the divorce decree call for a life insurance or a health insurance policy to be provided? If so, what are the terms of the agreement? Who provides for the children's education needs? Was there a quadro executed? And a quadro is a qualified domestic relation order, which is a penalty-free pension or qualified distribution for one of the spouses. Line C, 12 on Form 1040 refers to Schedule C. This, ladies and gentlemen, is one of the last great tax shelters in America. It's called a unincorporated self-employed business person. If a taxpayer has a profit or loss from a business operated as a sole proprietor, there's an entry on this line. And if so, you have an excellent prospect for estate and business continuation planning. Obviously, you need to talk about key personal life insurance or disability insurance. You need to talk about individual disability insurance, but there's a rub here. Most self-employed people run everything they can through their Schedule C. Would I get any disagreement on that? So consequently, by running everything through their Schedule C, they do what to their net income? They lower it. There's a problem. If they go to get disability income insurance or life insurance, this is their earned income. So that's something you have to be aware of. But they are also excellent prospects for long-term care, health insurance, qualified retirement plans, and estate planning. And Part 2 deals with the expenses, and here's why that's important. I had an actual case where a lady had a small grocery store, fish baits, minnows, worms, small tackle. Once again, typical small employer, the backbone of America. She ran everything through there, never paid any taxes. One day she got ready to sell it. Guess what? She couldn't get what she wanted for it. Why? The only thing she had as a record of how much money she had made as a public record was her income tax return. So it's a two-edged sword. You run everything through the Schedule C, you don't pay any taxes. But if one day you get ready to sell it, you can't get for it, obviously, what it's worth. So just something to keep, if you have clients who have Schedule Cs, just a little something to make them aware of, that one day if they get ready to sell that thing, they might start reporting a little bit more on their tax return. Now, here's another favorite schedule I like, and I'll tell you a great story of something I found here. Schedule D tells you what capital gains and losses a taxpayer has from securities transactions, property transactions, etc. First thing I look for here is there a lot of trading going on. And if there's a lot of trading going on, you'll see it on those brokers' accounts as long-term capital gains, short-term capital gains. And the question you want to ask here, if so, why did this excess trading take place? What purpose did it serve? Is the taxpayer doing the trading by themselves, or is a broker or money manager trading that account? What type of property was sold? Typical case here, I inherited a client of mine that was a investment client of mine, insurance client of mine, also did his tax return. His wife's mother died. We picked up, and he inherited the assets from another broker there. I was doing the tax return for the first year. I noticed something that was strange. The portfolio was B-share mutual funds that were being actively traded, and they were charging a fee to do that. So be aware that if you pick up broker statements or you look at Schedule D, you want to ask those questions, because these people did not have any idea that obviously they were in the investment they were in, they were being actively traded, which were commissions being generated, and they're also being charged a fee. I also had another case where I have a young dentist who decided that she was going to day trade. We now have an $800,000 loss carryover that she will never use in her lifetime. Why you need to look at that Schedule D. People need help out there. All right, line 15A on Form 1040 has to do with IRA distributions. And obviously we could spend hours talking about this, but we'll need to move along. So what you ask here, is this prospect receiving their required minimum distribution? Who are the beneficiaries? Are they arranged properly? Is this an inherited IRA? Are they receiving more than the required minimum distribution? Was the IRA a rollover? And does the IRA account need to be reviewed, rebalanced, or repositioned? And is there a better investment vehicle? And if the taxpayer is not spending the required minimum distribution, which a lot of people do not, let's help them find a way to help them reinvest that. Line 16A deals with pensions, and that could be a pension or an annuity distribution. If it's an annuity distribution, is it from a single premium immediate annuity? And then, as you know, part of the proceeds are tax-free or taxable. If you see a single premium immediate annuity, I ask the question, when did you buy it? What period of time did you buy it for? Who owns it? Who's the annuitant? And, you know, is it time to be looking at it for a prospect for a longevity annuity product? And they also could be a prospect for additional annuities. Okay. Back up a bit here. Okay. Schedule E. Another very important schedule. Part 1 includes income and loss from rental real estate and royalties. If there's real estate income here, you'd like to know if there's a mortgage on the property. Or is this a partnership of some sort? If it's a partnership, is there a buy-sell agreement in place? If there's a buy-sell agreement in place, is life insurance or disability insurance needed? If it's royalty income, are these royalties a source of discretionary income that you could be used for other planning purposes? And once again, we said if you have a taxpayer, a partner, or shareholder in one of these entities, then there are prospects for multiple sales opportunities, such as key person disability insurance, business continuation, individual disability, long-term care insurance, estate planning, etc. Part 3 of Schedule E shows income or loss from estates and trusts. Another very good place to find a source of investable assets. If a person is a beneficiary of a trust or estate, it will show the name of the trust of the estate and also the amount. If you see that, you want to make sure you get a copy of the investment statement. I did that on one. I discovered $500,000 in a money market account with no active manager. Never overlook Schedule E, income from estates or trust. First of all, if it's income from an estate, that means this estate has not been settled. So somebody's getting ready to get a pretty nice inheritance, and you want to position yourself to be the person there to talk to them about it. You know, and if there is a need for a beneficiary of a large estate, is there a need for estate planning and life insurance? Okay. Do you do any business with farmers in this part of the country? Fairly significant down in my part of the world, in Mississippi. A lot of farmers. Schedule F just shows if I have a farmer with a sole proprietor, his income or her income ends up there. The dilemma we find with in their prospects for all the various products, obviously, that you would have with Schedule C, the key person, life insurance, long-term care, estate planning, buy-sell agreement. What we find with farmers, and you may have, is that you have one or two individuals who are farming the land, and then you have 2 or 3 other siblings who are not. What is the dilemma there? Distribute it fairly. Life insurance is a great equalizer, and we've used it extensively, as I know you have, to make sure that if dad wants son or daughter to farm the land and wants son not to farm the land, then you can stabilize and equalize the estate by using life insurance. And David talked about this. Line 20B on Form 1040 indicates the amount of Social Security included in income. As we discussed, an individual could reduce the amount of Social Security by simply shifting unneeded taxable or tax-exempt income into some other vehicle, such as deferred annuities, single premium whole life insurance, etc. Line 29 on Form 1040 talks about a self-employed health insurance deduction. A couple questions here. Is it a group or individual policy, and are they satisfied with their coverage? Line 32 refers to where a person takes an IRA deduction. If they have an IRA, and you've heard David talk about the strategy, should they consider converting it to a Roth at this point in time? If they don't have an IRA, then you need to talk to them about one, either a regular or Roth. If they have a charitable intent and they don't need the money that's in the IRA, they could possibly roll their entire IRA over to a charity and take a tax deductible. You want to know how the beneficiaries are arranged, and of course, are there multiple accounts? And make sure they know what the contribution limit is every year. Okay, that tells you if a taxpayer is 65 years of old or older. And knowing this raises several questions. Are they taking distributions from their retirement plans? Do they understand what the required minimum distribution is? Do they need Social Security and Medicare counseling, and are they a candidate for long-term care and Medicare supplement insurance? I'm going to spend just a second on line 62 because it's pretty brand new, and I think some information I can give you here will put you in a little bit different position than any other broker that may be calling on your clients. This is the Net Investment Income Tax Form 8960. As you know, last year and this year, there is an additional 3.8% surtax on the lesser of net investment income or the excess modified adjusted gross income. So if a joint filer has MAGI in excess of $250,000 or a single filer in excess of $200,000, they're subject to this net investment income surtax. A couple examples, and I won't bore you with that. You can read that, how you determine that. And example number 2, another calculation of it. The point I want to share with you, though, is what can you do about this? This is a reason to call every client you have that you know makes more than $250,000 a year. This is an immediate reason to call. I had 3 clients that as soon as they did their tax return, what I'm showing you right here in this presentation, I sent to them. It generated some activity. So here's what you want to do. Here's how to reduce some of that. Invest in tax-free municipal bonds. The income doesn't count as net investment income. Switch from dividend-paying stocks to growth stocks. Hold on to the stock until you're in a year when you're not exposed to the net investment income tax. Use tax-deferred annuities to postpone or avoid exposure to this tax. One of the people I sent it to has adamantly denied even talking about annuities with me. I think I may have changed his mind a little bit when he saw how much of that tax he had to pay. Purchase rental real estate that will generate passive losses, and consider employing the following strategies. If you have capital losses, harvest them when you have years of security sales. The losses can reduce your MAGI by offsetting your capital gains plus up to $3,000 of ordinary income. Now, you don't have to be a CPA to know this. Most brokers know that if I'm going to sell your portfolio in a year, I need to match it up with the loss shares I got with the gain shares to minimize, the capital gains. If you know somebody contemplates selling real estate, maybe counsel them that they ought to do an installment sale. You can spread the gain out over years. You might want to convert your traditional IRA funds to a Roth. There's a one-time tax hit, but future tax-free payments won't increase your MAGI, and consequently, and IRA distributions don't count as net investment. swap property through a like-kind exchange. There's no current liability on this unless you receive boot. Excellent reason to go back and talk to your individual clients who are high-income individuals. Here's the next goodie. David talked about the high cost of Medicare insurance. Here's one attempt to collect more Medicare tax. If you make over $250,000 a year married filing jointly, $200,000 single, you will pay an additional 0.9% in Medicare tax. That's an attempt to keep it funded. Attempt. Line 61. Boy, this has been fun this year for the W-2 filers who walked in and got their refund, got their return done in 15 minutes, got their refund and walked in the door. And what is it? There's a place on the tax return now that you have to indicate where you have health insurance or not. And when you walk in, if you can indicate that you've had it all year, it's an easy process. If by chance you have not had it, it's about a 2 or 3 page process to go through to be able to show you had it, you had a subsidy, did you get enough subsidy, did you get too much subsidy, do you owe any money back? I've heard that there's been quite a few disgruntled taxpayers because of this. So leave it at that. Okay, winding down. Why is this important? This is who did the tax return. Normally a CPA, could be an enrolled agent. Why is that important to you? You might want to contact them. Introduce yourself as a member of the financial team. Could be a tremendous center of influence for you one day. So just some information. We'll move over to the expense side of it and wrap it up here. This is Schedule A where the itemized deductions are. Line 1 to 4 are medical and dental expenses. What's that tell you? If they're high, that means significant health insurance somebody's facing in the family. While you may not be able to help them if it's a person that's being cared for by another family member, it certainly would lend itself to talking about long-term care and maybe a need for health insurance. Schedule A deals with real estate. Are there high real estate taxes? If they are, that means that individual may own a significant amount of real estate. Are there multiple properties? Is there a mortgage on them? And are they a wealth transfer prospect or for estate planning? Schedule A, Form 1040, line 10 and 4. That's where you take the home mortgage interest. Interest rates have lowered substantially in the years. If you hadn't gone back to your clients and asked them should they refinance, you might ought to do that. If you're trying to sell them something and they don't have the money for it, by maybe suggesting they refinance their mortgage, if it makes economic sense, it may free up some source of discretionary income for you. Gifts to charity, this is where you find really what a person's real charitable intent is. If they have large amounts of charitable contributions here, you know you have an excellent prospects for charitable gifts of life insurance, wealth accumulation trust, etc. As you can see, I've tried not to make you an accountant, but to point out to you that within this federal tax return are numerous opportunities to discover situations where you can be of value to your client from a consulting standpoint, and also to create numerous sales opportunities. But in closing, if you review this W-2 and 1040 with your prospects, you could be the key to creating a relationship of trust. But if you never review them, I'll guarantee you, you don't know everything about them from a financial standpoint. Because if a person will share what their income is, they normally are sharing with you with their most intimate secret. But if you take the time and effort, you can uncover a treasure trove of opportunities to help your clients, create the trust necessary for a long-term relationship, and become an expert at uncovering problems and needs that make you all the more valuable. Thank you for your time.